Welcome back to Asia First. Wall Street continued its rebound as better than expected earnings turbocharged the major indices. Stocks have struggled to find a catalyst in recent weeks, but solid earnings from several of America's biggest financial firms boosted sentiment overnight. The Dow closed up 1.6%. The S&P 500 jumped by the most since March, up 1.7%. The Nasdaq also rose about as much. Bank of America saw its Q3 profit soar 58% on year as its lending business started to pick up from the pandemic slump. It also released money that it had squirreled away last year at the height of COVID-19 lockdowns in the US. The firm benefited from better than expected loan losses, record advisory and asset management fees. Investors cheered those results and its stock climbed 4.5%. Morgan Stanley posted record earnings in investment banking and asset management. It benefited from a surge in deal making, capitalizing on a spate of M&A activity. The New York-based firm saw its shares rise 2.5% by the close. Citigroup also beat the street for its third quarter. It delivered a jump in profits helped by trading revenue. Similar to Morgan Stanley, it saw a rise in deal making that helped offset its sluggish loan book, and its shares climbed about 0.8%. Let's bring in Thomas Hayes now. He's chairman and managing member at Great Hill Capital. He's joining us from NYC today. So Thomas, even before these solid bank earnings scorecards where they've benefited from the deal making and trading windfall, you felt that Wall Street was getting a bit overly pessimistic. But we see how on their earnings scorecards of these banking giants, their Main Street loan growth remains muted. You don't think that this foreshadows what's to come for the rest of the earnings season on the Main Street related stocks?
Yeah, well, the lending, Averill, is a lagging indicator. Thanks for having me tonight. As you said, we saw top and bottom line beats. JP Morgan yesterday, Wells Fargo, Citi, Morgan Stanley, Bank of America. And we also saw record great earnings from United Healthcare. So really across the board, we came into this quarter expecting 27% earnings growth was the consensus estimate. Over the past 5 years, estimates have been beat by over 8%. That would take earnings to 35% growth. But in the last 5 quarters, earnings have actually beat by 19% a quarter, which means we could see earnings above 40% growth year on year. And what's important about that is not what's happened in the past in Q3. What's important about that is they're going to have to take forward guidance up. And that's the name of the game. Right now, consensus earnings estimates for 2022 on the S&P 500 are only $220. We think by the end of the earnings season, by the end of the year, that's going to be well above $230 for the S&P 500. That's going to take the multiple down. It's going to make the market look less expensive, and money's going to flow into the market. So things are looking very promising on the economic front in the U.S.
What about some of the downside risks that the markets are concerned about, namely supply chain disruptions and the Fed pulling stimulus? We see how you are quite certain that we could see how the non-farm payrolls missed from last Friday will mean that the Fed doesn't pull out its stimulus as soon. But we also have jobless claims that at this point seem to be reaching those pandemic era lows.
Yeah, there's no question the jobs report was not good. It missed expectations. That's the bad news. The good news is that's going to give Fed the cover to push off the taper announcement from the November meeting, November 2nd, to most likely December 14th and 15th after we get better jobs reports in October and November. The reason the jobs report was poor in the month of September was twofold. First and foremost, you had the Delta was at its peak in the United States the first 2 weeks of the month. It was really accelerating. And number two, the extended unemployment benefits were rolling off in the month of September. So now that there's no additional public support, many people are going back to work. The kids are back at school, so parents can get back to their jobs. The October report and the November report will meet Chair Powell's standard of a decent jobs report to move ahead with taper late this year or early next year. And if you look at 2014, when taper was happening the last time, it was announced December of 2013. Over those 6 months of taper wind down, the Fed balance sheet actually increased from purchases and reinvestment. And the stock market had mid-teens gains in 2014 while the tapering was running off. So we think that the market will be less calm in 2022 than it was in 2021. We only had 3 to 5% pullbacks. However, we do think it can be a healthy year, as we're going to have over 10% earnings growth and over 4% GDP growth in 2022.
Okay, let's compare that to what we see from the PBOC, where the Chinese central bank has reduced its credit support a lot earlier than its U.S. counterpart. You see that as a hindrance to growth?
Yeah, there's no question about it. The Chinese government actually tightened policy very early this year. They thought the pandemic was in the rearview mirror, but it was just ramping up on a global basis, and that's really hurt them. By the second half, they realized they had made an error. They reduced bank reserve ratio requirements by 50 basis points in July. However, as we know, everything has a lagged effect of 6 to 9 months. So the economic numbers continue to go down with the regulatory crackdowns, with the real estate problems they have. That's all bad news. The good news is it's going to force them to reduce those bank reserve requirement ratios again by another 50 basis points, either in October or November. And they may even have to reduce the policy rate by the end of the year, which would be very stimulative for the Chinese economy and stabilize things and move things ahead into 2022. But they have to act quickly. They have to catch up for lost time. They tightened too soon.
Okay. Thomas, we'll leave it there for today. Thanks very much for your time. Thomas Hayes of Great Hill Capital.